Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's podcast conversation. I'm really excited to have with us today Matt Kopko, who is the Vice President of Public Policy at DailyPay, a really interesting and impactful fintech company that helps so many people make a much better living and have a smooth income. And I think there's so many different aspects to this, from improving outcomes to improving access to finance, that we're going to jump into and open up. With that, Matthew, welcome to the podcast.
Great to be here, Lex.
My pleasure. So let's start with some of the different vectors in your background that brought you to your current position and to your current company. What do you think are like the core foundational career experiences that you've put together?
Without giving you my life story, generally my professional career, the arc was I started as an attorney in private practice for a few years, got an opportunity to go into the government and serve as a regulator in the federal government at the United States Department of Transportation. And then after that, kind of came back out into the tech world and have been focused on the intersection of emerging technology and regulation. So after I left the government, I joined Bird, the scooter company, was in charge of Bird's legislative portfolio and a lot of its government relation operations, and then was able to find a great opportunity at DailyPay in the fintech space here in New York to be able to do all that and more in helping people improve their financial health and make life work in between paydays. So, mix of legal background, regulatory background, and startup technology operator background.
I want to kick around a little bit your entrepreneurial experience, which I think you actually had quite a bit of it. Was it while you were in school, while you were doing your undergrad, or what were some of the earlier entrepreneurial and technology experiences that you had?
Yeah, sure. Well, I was starting all kinds of businesses as young as being an early kid, magazine selling businesses and building websites and things like that when I was just a teenager. And then started a couple businesses during my college time. One was called Doormate. It was a college services business to help kids, get grocery delivery, laundry, and room cleaning services and all things like that. Not a very tech-heavy operation, but one of the more legitimate early in life entrepreneurial activities. And then I went on to grad school. I joined the University of Chicago and was part of the JD MBA program there and started a business in grad school and was lucky enough to be selected into the Y Combinator program in 2011. So I was a founder in that class. That was the first class that had substantially increased the funding amount they offered founders. I think we got something like $150,000 to join that program. That startup didn't take off. It was sold to another tech company in the Valley. And I went on from there to hone my skills as a lawyer for a few years and then found my way back to tech. So, entrepreneurship and creativity is kind of in my DNA. And, it's been part of my life since I was a young kid.
So you've both started businesses and then you were the technologist building businesses. I made a similar mistake with the JD MBA at Columbia. And you could say I made a similar mistake in starting my first company while doing the JD MBA. So I can relate to that experience. What pulled you into the law, outside of just the sunk cost of doing the JD? What pulled you into the law after these earlier entrepreneurial experiences? Can you talk about what it is that motivated you?
Yeah, I'd be lying if I didn't say part of it was the sunk cost. I definitely felt that it would have been silly to invest all those years and time and money into getting a law degree and passing the bar only to not practice. But I've also been,
it's worked out for me. I'll tell you that.
Yeah, no, I don't fault anyone who doesn't do it because it's not exactly the most enjoyable experience. But for me, I can't say that my parents didn't have some choice words for me from time to time to say, hey, you should at least try to make something out of this asset you've built. But, I had a great opportunity to join one of the best law firms in the country, Simpson Thacher, trained under some of the best lawyers in the world, probably. Cut my teeth doing a lot of private equity work, and then migrated after a few years to do more venture capital oriented work. So it's been a great foundation for me. It helps me be a great strategic thinker. But the way I've tried to build my career is, like to have that expertise, but don't want to just be a lawyer's lawyer. I want to be, a business person who has legal capabilities.
I don't often get to have a conversation about this topic, so forgive the aside, but I want to ask you the juxtaposition of a point of view from the legal side, like learning to think like a lawyer, learning legal analysis, the strategic mindset from a legal point of view, versus on the MBA side, or more generally from an entrepreneurial side, as a business builder, that's also a different skill set and a different strategic point of view as well. And I think we describe them as kind of the same thing, as being more analytical or being able to make better decisions. But there's some pretty fundamental differences and assumptions in terms of how a person behaves on both sides of those skill sets. I've had to rationalize that for myself, and I'm happy to share. But before doing that, I'd love to get your thought on what are kind of the foundational things that a JD and the MBA gave you in terms of a strategic skill set? And then how do you reconcile them into something that isn't just entirely contradictory?
Yeah, so I agree with you that the experiences in business school and law school were very different skill sets focused for sure. I would say when I was in law school, some of the key skills I think came out of that time were, this idea of structured thinking, being able to kind of break things down into very step-by-step bite-sized concepts, which is, kind of core to the legal training in the United States here. And then the other thing, they train you as a lawyer to do, for better or worse, is this thing called issue spotting. So, you're focused on looking at a fact pattern, looking at a situation, and trying to think through all the things that everyone should be concerned about, or all the things that you want to make sure go right or don't go wrong, that kind of thing. And then I found too that being able to go through the whole legal curriculum at a place like the University of Chicago, which is, just a fantastic legal education, the amount of complexity that you're exposed to and having to keep, juggling in your head all at the same time is really pretty intense at times. So compare that to the MBA, where it's challenging in a different way, right? There's a lot more focus on quantitative work. There's a lot more focus on collaborative work, group projects, those types of things. And so I think each of them have their own merits. I always, like I said, always wanted to be more than, quote unquote, just a lawyer. So it was a great opportunity for me to be able to do both.
One of the things that stuck with me through the experience is the opening and the closing mindset, where in the first, you're kind of trying to throw as much sand and chaos into the air, and experiment and try to see what sticks and try to see for any evidence of demand that you get in the market. And that's very much the sort of the creativity of business making. And then the other side is, for me at least, was the opposite. It was, okay, there are all these things up in the air. What are the demarcations between them? Where do they bump into each other? Where are the contradictions? And, what are the principles and rules that can be drawn around different concept spaces to organize behavior and to guide people around it? And I find that to be really useful in frontier technologies, surprisingly, like that legal training, when looking at platform shifts or looking at very uncertain places where you're not just trying to project strategy in the sense of how do we grow 20% per year, but you're trying to project strategy and use analogies and metaphors and try to figure out precedent from the past and then apply it to the future in really uncertain industries. I was surprised to actually see that training be quite helpful.
Yeah, it's been immensely helpful. And, for me, it's almost like a critical core training to what I'm doing now. I don't know if I'm here because of my training or the other way around, but, I live at that intersection of emerging technology. Some call it disruptive technology. I don't really like that term, but emerging technology and a legal system that tends to kind of lag and catch up to technology. So, I've lived in this space for, several years now in a couple different industries. And, the things that you talk about there in terms of looking to historical precedent, even if it's recent historical precedent, seeing how maybe someone in a different industry might have dealt with a potentially similar legal blocker and how to, innovate your way through it, around it, over it, under it, or, just accommodate it. So, for me, I certainly couldn't be a lawyer working or a policy person or a government relations person, working in this regulatory compliance legal space, without that legal training for sure. And I don't think I'd be good at it without the business training either, because, there's a lot of folks who just go into law firms and kind of stay there for the rest of their careers. And that's great. A lot of them are very successful, but it's a different skill set, right? When you're kind of crunching on deal matters at a law firm versus kind of living in an environment with a lot more uncertainty, that is the tech world in 2022.
It's the difference between reading about something and doing the thing about which people write. If we transition to your experience with the Department of Transportation and more generally in public policy, what was that like? How did you start to reconcile, or maybe what is the lens through which regulators were looking at technology, and what kinds of issues did you start to run into that maybe weren't there in your career prior?
Yeah, I mean, it was one of the most fantastic experiences and opportunities in my life to serve our country and the federal government, and being able to walk the halls of the West Wing and be in the EEOB complex are just things that, I kind of pinch myself and look back and say, man, did that really happen? But more directly to your question, I mean, my experience was I came in at that point having legal training and some venture capital training and my entrepreneurial experience. Given my connections to some of these worlds and some of the investors and makers who are working on some of these technologies, I worked as essentially chief of staff to the deputy secretary, who's the COO of the department, in kind of natural parlance. The deputy secretary is number 2 in command, kind of runs the department day to day, and the cabinet secretary is dealing with a lot of things beyond just the day-to-day operations of the department. And one subspecialty that I was handed was a lot of the emerging technology portfolio. There are others who were on the team working on it, but I got to have substantial involvement in programs like Hyperloop, like electric vertical takeoff and landing technology, eVTOL, or people call them kind of flying cars. Some of the early drone regulations that were put in place, I was closely involved in. And one of the things that I saw and learned was, kind of what I've dealt with in my career since, which is there's an existing legal and regulatory framework, and then people invent new things. And then there is often sometimes a struggle to figure out how to fit something new into the rules that have already been written. And when those rules are statute, you got to go back to the government to get them changed. When those rules are regulation, you got to write a new rule potentially. And depending on who's doing it or how you're doing it, the federal government, that can be a years-long process. So I found myself pushing up against the bureaucracy from time to time, kind of trying to always push the envelope and say, hey, how can we be faster here? How can we be more accommodating of new technology? One thing that I saw in the eVTOL space that had me very bothered and concerned was we were talking about it, in the United States, and there were some people kind of off in the desert doing a test run or two. And then, one of the Arab states had announced that they were going to start doing commercial taxi operations, I think by 2023 or 2025. And it was just a timeline that was years ahead of us. And I realized, if we kind of take our sweet time here, a lot of these markets may pass us by. We want to be able to be the hub of innovation, the first mover, the developer and core creators of all this technology. And if our legal strictures and our legal system holds us back from being able to innovate, we might lose that edge to other nations. There might be, a new Silicon Valley outside of the United States one day, and that might already be happening. But my view was we need to do everything possible in our power to keep that innovation here, keep it moving here, having the U.S. being thought of as a pro-innovation environment. So always pushing to make sure that the drone pilot program was stood up as fast as possible. I was an interface between industry and the FAA to make sure that there was messaging from the cabinet level that we should be embracing these new technologies, not kind of finding ways to have them struggle along and limp along for 8 years. And I convened actually one of the first regulatory frameworks for Hyperloop. That was a great example of literally nothing fit, right? Like when you think about an eVTOL or a drone, there's a lot of analogs in the, FAA aircraft space, right? But Hyperloop is weird. It's like kind of a train, but not really. It's a levitating device. And so what we did is we pulled together essentially a cross-functional team between the rail division and the highway division, and said, we're going to use a mix of your powers to make sure that we can keep moving forward so that these projects can keep moving forward as well. So, I remember, being in the deputy secretary's office, and the mayor's office of Chicago was calling saying, hey, we're looking at doing this cool thing with Elon Musk. Is this something that's going to work from a regulatory standpoint? And we were always there to provide assurance to say, hey, please embrace this. The rules are being worked on, the rules will be written, and it's an evolving world we're in, but we're here to support it.
I'm going to go at it a little bit sideways, which is to ask about the purpose of regulation and maybe public policy, maybe legislation around emerging technology. And the place where I'm coming at it is from thinking about, one world in which the government is actually the catalyst of national competition and the catalyst of society-wide innovation, right? So if we think to around World War II and after, kind of the role of the US government in catalyzing nuclear research, in catalyzing what has now become the internet and the World Wide Web, looking at space travel and the rocket technologies that took a gigantic leap forward there, or, looking at things like GPS, without which we couldn't have Bird, certainly, but also Uber and all these other things. To me, there's sort of like, I didn't have this as a lived experience, but as a story, there's the story of kind of a strong government interest in national competition based on innovation and technology and investment and so on. And I feel like a lot of that narrative has melted down. First off, like innovation is happening in industry, right? Rather than in these large government funded projects. And then industry kind of expects regulation to just be a friction, like a compliance net that's put on top of new ways of doing stuff. I guess I'm just looking to respond to that. Like, is that right? Why is that? What are some of the underlying reasons for the current equilibrium?
First, one thing I've noticed in the past at least couple years is there's kind of been this pendulum swinging. It used to be tech can do no wrong. Tech is the harbinger of a bright future, to, tech is scary and we must be skeptical of it. Peter Thiel has that famous quote where he says, we wanted flying cars and instead we got 140 characters. So I think people are definitely wrestling with this idea of it's not all black and all white, right? Technology can be used to create amazing things, and technology can also be very powerful and used to the wrong ends if it's not used properly. I mean, there's a lot of public conversation now about what are we doing to our collective attention spans with all these news feeds. A lot of these apps are built to essentially make us addicted to them. And so I think people are grappling with, the longer we've existed with some of these new technology developments, trying to parse out which ones are for good and which ones are maybe not for good. And the government certainly has a role in all that. You mentioned the Manhattan Project and World War II. We also have things like DARPA and the X Prize that have created all types of innovations. I think you alluded to that with the development of the internet. And so, the way at least I've experienced it in my short career so far is there certainly is a national interest in accelerating innovation and competition. And it's not as much that I've seen that government is the creator and generator of it, right? Like those Manhattan Project moments or those X Prize moments. Now it's more, how does the government create a structure where innovation can happen, responsible innovation can happen, and it's not kind of, zombied or cut off at the knees the moment it gets, runs up against any sort of gray area in the law or thing like that. So my experience with government has been, how do you protect consumers? How do you protect the American economy? How do you protect American interests internationally without creating an undue burden on the innovation ecosystem? And it's not just because, you don't want to create any burden on that ecosystem, but, if you are too heavy-handed, with the innovative folks in the country, they'll move elsewhere, or, new developments will be generated, in a different environment where, there's more freedom to tinker. So, it's always a tough balance I've seen. And, my job when I was in government was to, keep the government, out of the way in terms of making sure people can still experiment, develop, and tinker. But at the same time, for example, with eVTOL, right? Like the FAA has an amazing safety record, right? We don't even really think about it. There's 40,000 deaths on our roads a year. And, aside from a very tragic crash here and there, orders of magnitude fewer, almost zero, not zero, obviously, but almost zero air-based deaths every year. And so the FAA is coming at this from a different mandate, which is, safety and prevention of death at all costs. And we kind of, for some reason, just assume in a different mode of transport on surface on our roads that, it's okay for 40,000 people to die every year.
Right. I think that's why the Kardashians take their private plane everywhere.
Right.
It's for safety. Thanks for spending time on those ideas. I think they're really key. And I do think that the shape of the world and the shape of kind of like the garden, the innovation garden, really depends on the government's posture. My hope is that there is a more proactive posture as we get maybe through some of the more crunchy and difficult issues around, inequities and distribution that I think are one of the brightest kind of focuses of negotiation and disagreement. But putting all of that aside, let's switch to DailyPay. So we've taken a bit to get here, but I'd love to know more. Can you tell us about just what DailyPay is and how does it work?
DailyPay is the nation's leading employer-based earned wage access provider, which is a long way of saying, we're trying to flip the payroll cycle on its head so that people can get paid as frequently as they need, right? You earn money every day, but you're only paid typically every 2 weeks or 4 weeks. And we now have obviously the technology to be able to facilitate more frequent payment. And so DailyPay is a layer that works through an employer's systems so that their employees can monitor their net earned pay as they earn it on either a daily or hourly basis, and then access that pay on demand. Some people need to access it multiple times in a given pay period because there's something going on in their lives, or some people just use it to watch their earnings grow and don't even engage in a financial transaction. So it's this new layer now that sits on top of payroll systems that allows employees to get paid as frequently or infrequently as they need, with the baseline being the normal payroll cycle, and then we can make it as frequent as possible from there.
So what's the reason that we have a regular payroll cycle?
Yeah, there's been a lot of kind of historical claims I've seen about that. The best I've been able to piece together is the advent of the income tax system started forcing employers to have to now accommodate for withholding of taxes, which forced them to start paying on a less frequent pay cycle. And then in the decades since that, some at the federal government through the IRS, but a lot at the state level as well, have layered on all types of payroll compliance rules. And so, what companies have found over the past decades is it's most efficient to run payroll once or twice a month. And there's all these stats out there that I know very well and dear to my heart, that roughly 2 in 3 workers are paid only once or twice a month. And so, this is like kind of the current status quo for most of America.
So that's really interesting. I would not at all have guessed that income tax is the reason. And I know that you're not saying that's the main reason or the only reason, but it sounds like it's a but-for reason. There are analogies within a lot of different payment operations part of fintech where the delay actually has like a workflow rationale, right? So for example, in capital markets, lots of trading doesn't settle immediately. It settles T+1, T+3, T+7, whatever, right? Where it's 3 days, 7 days, and so on to actually settle the transaction and reconcile things and move the cash around. And then having that hang out creates a liability on somebody. In the capital markets world, that liability is exposure that somebody will default. But in the employee world, if you're working and you don't get paid, actually the exposure is on you because you're effectively lending money to your employer. They owe you the salary. You need the salary because you've got flowing expenses, but you're lending money to your employer.
I'm glad you mentioned that and not me.
Yeah. Is that controversial in some circles?
Well, what I find, and we'll get through this probably throughout the podcast, is, when I engage with skeptics of the industry or other stakeholders, there's this conversation of, well, if someone's getting their pay early, isn't it a loan then? And the way I think about it is exactly how you just elucidated it, which is people have earned this money on a daily basis. It's just because of the weirdness and the intricacies of the payroll system that they're only paid once every 2 weeks. And so just as you said it, employees, if you actually think about it and take a step back, are literally lending to their employers for 2 to 4 weeks at a time to say, hey, you owe me my wages, but don't worry, I know you're good for it, so you can pay me every couple of weeks because it's easier for you.
This opens up a whole can of worms around, digital money, programmable money, real-time accrual and movement, and so on. And I think until all of that workflow that attaches to payment processing, until all of that workflow is fully digital and all the systems that it plugs into are fully digital, until there is no fax machine anywhere in the country printing anything, we're going to end up getting stuck in these kind of time gaps with liability and exposure for people. I want to ask you to frame now, on average, what is the financial situation of an employee, right? If you look across kind of the DailyPay footprint of companies that you work with and you look at, the average employee, what is their financial situation? How do they relate to their paycheck?
We have a very large platform, I think the largest in the nation by far, over 500 enterprise partners on the platform, accounting for over 2.5 million eligible employees. 2 of the largest 10 employers in the nation use DailyPay nationwide for their workforce. So we're, not a lot of people I think know our name, but we're really enmeshed in the HR tech of the economy. And so a lot of the industries where this type of technology is attractive is, as you can imagine, low to middle income earning type industries. We have a lot of hourly workers on the platform, a lot of folks in retail and grocery industries. We have actually a lot of healthcare and other industries that you would consider kind of frontline workers, a lot of hospital systems, home care systems, healthcare adjacent industries as well, hospitality, quick service restaurants, all those types of things. So it's a lot of people who, tend to be on that bottom half of the earning spectrum. And, candidly, it's the people who need this type of flexibility most, right? There's all these stats out there that, 3 in 4 hourly workers are living paycheck to paycheck. Most employees can't handle a $400 exogenous shock to income. And we're asking those same people to go 2 to 4 weeks at a time without being paid, but they're not in control of when their rent check is due. They're not in control of when one of their kids has to go to the doctors. They're not in control of, when they're able to get off work to be able to go to grocery shopping. And so what we found is this tool is immensely powerful to really help people reclaim their finances. And our platform, I think we're very proud, and a lot of the work I do on the research side, in addition to all the regulatory work I do, is understanding how our users use the platform and ensuring that it's overwhelmingly used responsibly, because this is something that exists to help people make their lives better. And we want to make sure that's the case in real life.
So I'm going to have a provocation, which is the other choice that this demographic has is quite predatory, which is payday lending, with pretty ridiculous interest rates on advances against paychecks and so on. Can you frame the experience of an employee in terms of they're working at a company and then they have an expense? If they were to go the payday lending route, what would that look like? And then if their employer is using DailyPay, what does that option look like? And what are the economics there?
Yeah, glad to talk about that. And then also want to talk about overdraft as well. But, you mentioned something that's really near and dear to my heart. I've done, directly through my work and also through multiple objective third party, looked very deeply into this world because it's critical kind of to the value proposition of DailyPay. And so generally, about 5% of people take out a payday loan over a 2 to 5 year horizon. What we found is this user base, is multiples more likely to have previously relied on payday loans. So instead of something like 5% of the DailyPay user base has recently taken out a payday loan, it's more like 20%. And the general economics on payday loans are just horrendous. So, the best way of describing it is it's essentially $45 in fees and interest every 2 weeks. But, the little known secret to the general public, but it's well known in policy circles and financial regulatory circles, is, the payday lending business model is built around reborrowing and what people often call the cycle of debt. So the Pew Charitable Trust, a great nonpartisan nonprofit, looked in depth at the payday loan industry, and they found that because of the way the incentives are built, the average payday loan is about $375 in size. And on a loan like that, the average person will end up rolling it over 8 times, and before they're done, paying $520 in interest and fees. So, $45 sounds bad, but not crazy. But $500 over, 4 months or whatever it is just unfathomable. And so,
I mean, the psychic toll of that, right? Like outside even just the money, because some of our audience might not relate to the money point, but everyone can relate to the feeling of having an obligation you can't get rid of. No matter what you do, like rolling it over 8 times is horrific, right?
yeah, it gets worse sometimes for people. I mean, that's the average, right? Some people, we've seen these horrible cases of they stay in payday loan debt for years. They're paying thousands of dollars in interest. Their balance is greater than when they started. And it's like they put themselves into some, bizarre form of indentured servitude because their tire broke. And so you compare that to a DailyPay, where DailyPay transactions are kind of, our pricing is generally kind of like Venmo, right? It's for the most part, depending on the partner, but we'd like to offer people the ability to have their earned wages accessed for free if they can, wait a day or two using the legacy ACH rails. And if you need an instant transaction, there's a nominal processing fee of typically $2.99. What I want to be clear, and I'm always clear to preface for folks, is, for some, all you need is one DailyPay transaction. But even if you needed to use, DailyPay once a week over those same 8 weeks, right? On an average $2 fee, you're paying maybe something like $15 to $20 in fees as opposed to $500 in fees. And so, we are at a minimum, I think, taking a zero off the cost there, at least an order of magnitude reduction in the fee burden. And so, from our standpoint, it's, perfection is getting down to zero fees. And we like to give everyone we can a free option to access their earned pay. But being able to turn $500 of predatory fees into, $3, $10, $20 of much more reasonable fee burden is life-saving for a lot of people. I mean, we're talking about people who are often making $30,000 a year of gross income. And then after taxes, I mean, being able to suffer $500 or more in payday lending fees is just like game over.
You mentioned overdraft, and I want to go through, if you can, through the microeconomics of that too, because overdraft is a nice profit center for the large traditional banks. It's a very upside down model often in retail banking, where the people who are, again, the most squeezed end up paying the most for just the very basic access to accounts. And having the ability to go negative is not necessarily helpful, because you do get the interest rate and you get the overdraft fees. There's a perverse incentive there because the bank, end of the day, actually wants you to overdraft, and they want you to go negative and start paying interest rates. So they're not necessarily incentivized to fix that problem. Can you talk about, again, on the margin, what do those economics look like for people? And then if you've got a view on that part of the banking world.
Yeah, sure. So, I sometimes refer to overdraft as the silent killer, because a lot of people kind of focus on the payday part and don't even understand how big of a problem overdraft is. The overdraft industry is as large or bigger than the payday loan industry. Depending on the estimate, it's anywhere from $10 to $30 billion a year in overdraft fees to banks. And a couple things about overdraft, right? The typical overdraft fee is $35, right? Compare that again to a DailyPay fee of $2.99 or nothing. And then also the other thing that you find is vulnerable communities and low-income communities tend to be heavily concentrated in overdraft reliance. So that same research that I did about the payday reliance of DailyPay users before they had access to DailyPay similarly showed that 2 in 5, about 39%, I think was the actual number, but 2 in 5 generally had resorted to overdraft previously as a short-term gap to get them in between pay periods. And over half of that group, so over 1 in 5 of the whole population, have reported relying on overdraft either monthly or more frequently than once a month. So imagine having to, have 2-3 overdrafts a month. That's $105 out of your bank account just in 1 month. And so again, the same dynamics and substitution effects we've seen for payday exist for overdraft. And by the way, I'm not just talking about kind of a hypothetical mathematical analysis here. We did substitution research here. So what we found was, of the folks who were previously reliant on overdraft or payday, 4 in 5 of them were able to report to us that they had either stopped relying on overdraft or payday entirely or were rarely reliant on them now. And then an additional about 15% of the remaining 20%, so 95% in total, reported lesser usage of payday loans or overdraft fees. So I'm very excited when I see 4 out of 5 people essentially being able to say, I'm cured of the predatory cycle of debt because of DailyPay.
If I were a bank, I would be unhappy with you.
Well, here's what I'll tell you. There's been a lot of pressure, from us, from the market, and also there's a lot of saber rattling in the government space on overdraft. And what I'll say is, DailyPay is a leading employer-based provider of earned wage access. We don't offer it, generally to the general public. We offer it in a verified employment environment so that we can verify earned income and provide it through payroll in a seamless environment. But we're also increasingly providing this service on either a white label basis or as financial infrastructure. So we have a great partnership with PNC Bank, and actually PNC came to us because they said, hey, look, I see the writing on the wall. People want banks to start doing more pro-consumer things about the overdraft space. They enacted their own overdraft reforms, but they also partnered with DailyPay to offer DailyPay to all of their commercial banking clients as another benefit to help undermine, the dangers of overdraft. So we think we're part of the solution to overdraft, and we're partnering with banks to be part of their arsenal to be that solution.
So I guess we come to a key question, which is we're replacing some of these negative loops and negative economics with, a different solution. And you've got something like 2.5 million employees that are eligible for it. What is the business model? Like, is the $3.99 the transaction fee for non-ACH upfront transfers? Is that the kind of the core driver of revenues? Is there some sort of underwriting going on when you're assessing the risk of somebody getting their paycheck or not? Like, how does the financial machine work?
Yeah, the business model at this point is essentially very similar to a Venmo, right? A majority of our users appreciate and rely on the flexibility to be able to access instantly their earned pay. And so our business is generally funded off of those nominal processing fees. Everyone thinks, $2.99 isn't a lot, but when you have millions of people, transacting on the platform, those numbers add up, pretty sizably, just to ask Venmo. And then increasingly we're doing very cool things like partnering with banks, like I've said. And then what we see as part of the future as well is our employer network is so powerful that we can start providing additional consumer benefit where other parties may want to take on that fee burden for the opportunity of having a commercial transaction with some of our users. So, imagine, an offer, for example, to get 5 or 10% off if you use DailyPay to shop at XYZ retail outlet versus the competition. And now all of a sudden, the merchant is essentially paying DailyPay to be able to have access to that business opportunity, and the users benefit because they have now a new party who's willing to, essentially pay for those transaction fees to be able to have access to your business. Similarly, banks are now interested in acquiring new customers and having new banking relationships with them. And so we have partnerships with banks. We've rolled one out already where, if you open an account with Current Bank, for example, you can get access to DailyPay for free in a lot of circumstances. So what we think is, the basic business model is fantastic and sustainable and has helped us grow at an amazing level with pretty good economics. But increasingly, we see financial partners and the general economy as likely partners to want to help people use that pay balance to buy something cheaper or have some sort of other commercial relationship.
It makes me think of other financial wellness companies, whether it's, NerdWallet or even things like Acorns, where you would be able to take microtransactions and start building longer term investment savings or retirement savings or insurance and kind of start adding up to a broader financial experience. But I'm guessing that in this particular income bracket, those products aren't what matters. It's the savings and the budgeting and the cash flow.
Yeah, so being able to access your earned pay without going into debt is a critical benefit for a lot of employees. And then a couple other things I'll mention is we have a savings tool as well. So you can use DailyPay for free. It's compatible with any savings account, and you can earmark, either a certain dollar amount of your paycheck or a certain percentage of your paycheck to, keep it away from consumption and send it automatically to savings every time. So you don't need to actually go to HR anymore to set up a split direct deposit. You can do it directly through DailyPay. And then we have some exciting things coming out in the coming weeks, I'll just say, that are going to make people's ability to work with DailyPay even more comprehensive. So it's not just a tool to get access to your earned pay. There's going to be an environment going forward where you may want to be, transacting out of a DailyPay environment because there's better economics for you as a consumer.
Well, if our audience wants to learn more about DailyPay or to follow you and stay connected with you, where should they go?
We're on dailypay.com, so you can learn all about what we do. And if you're an employer, reach out to our team to see how we can potentially provide benefits. We didn't even talk at all, by the way, Lex, about employer benefits from earned wage access. It increases retention and reduces employee turnover. So there's a big reason employers want it as well. But please go to dailypay.com to check us out. I'm on LinkedIn. I'm not terribly active on Twitter or the other social media platforms for some of the reasons we talked about earlier. But you can find me on LinkedIn.
Thank you so much for coming on the podcast today.
Awesome. Great to speak with you.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.